everyone. This is John Feneck with the Feneck Commodities Report. I'm joined today by my YouTube partner, Don Durrett, founder of goldstockdata.com. And Don, it's been a heck of a year. Welcome back.
Well, I'm not super excited. I mean, gold's up 30%, but the miners aren't. So it's kind of a
Yeah.
disappointing year in many respects.
Yeah. Well, it's been a lot of ups and downs. And, that's why we trade a bit more than you do. I mean, we got out of a lot of things, thankfully, in October leading up to November 5th, just because the election was freaking me out a bit. It was pretty close, but it wasn't close in the end. And I wasn't expecting this kind of reaction. I guess twofold, right? The sell off, immediate sell off almost in miners and gold silver after November 5th, somewhat of a recovery since, but more so the euphoric reaction to so many asset classes such as Bitcoin and just risk on like exponentially, right? So that to me is a bit surprising. I know you and I have talked about the S&P and different levels to watch, and things just keep ripping higher.
Yeah, I think the S&P, in my opinion, is really from gold and silver mining perspective, the S&P is really the only number that matters. Everything else is
Yep.
just noise. I don't think that gold and silver can basically break out on their own. So they have to follow. They have to follow the stock market. So it's basically the S&P is really the only number that matters. I do not believe that I could be wrong here, but I do not believe we're going to get 3 consecutive years in a row of basically, ripping Wall Street. In other words, I do not believe for a second that the melt up that we've had over the last 2 years, 24% upside in 23, and we're at
Right.
29% 24. I think this is going to be a down year. I don't think we're going to go 3 years in a row. For instance, right now we're at 6,000 S&P. I do not expect to be above 6,000 at year end. So that's going into the year. That's my mindset.
Got it. Okay. Before we get started on just a little bit of macro on gold and silver, because we may not record until right around the inauguration, what do you think about like Trump's immediate impact? Do you fear, or is your mindset that Trump could have an immediate impact on markets starting January 20th? And obviously, if you're a Fidelity or a Vanguard out there, you're not selling on January 19th, right? You have to sell many days in advance of this to cover yourself, right? Because you have such large positions, you're going to move markets. So, what do you think January looks like?
It's it's really interesting because um, you have to make a decision as an investor. Is Trump's policies going to override the budget deficit? Because the budget deficit, in many respects, is kind of already in a doom loop where you have debt to GDP 120, 125%, and you have these twin deficits of budget deficit and trade deficit. Normally, in that scenario, you're toast. And so you have to have this belief that because he can't really get that deficit down very much. He doesn't have control over the budget. This year's budget, it's already kind of in play. They approved those budgets prior to October, and then it starts in October. And so he can't
Right.
really get it. We're 2 trillion. We're looking at a $2 trillion deficit. He can't really get it down that much this year. So there has to be confidence that we're going to be borrowing the U.S. Treasury is going to be borrowing a lot of money every month, and so there has to be this
Yep.
confidence on Wall Street that it's okay. We're going to get a soft landing. Trump's going to be able to keep that bond market strong. They're going to be able to borrow whatever they need. It's like you have to have people are going to have faith that Trump's going to be able to kind of fix the budget because the budget's out of control right now. $2 trillion deficit is out of control. So you have to have this confidence that we're going to get it under control. And so I don't know when the market, I have this 3, 6, 9 month period. I don't know when the markets are going to finally give up on that fantasy. I think it's fantasy because we can't pay the debt off. So all we're really doing is kind of kicking the can down the road and pretending that we can keep expanding like the national debt to 40 trillion, 45 trillion. We can keep expanding the national debt. We can keep borrowing what we need. The US dollar is going to maintain the global currency, and that's going to be okay. And everybody's ignoring the fact that the US dollar as a global reserve is being whittled away. It's actually in the process of dying. So how low can that get? The number of amount of money, US dollars, that are used for cross-border transaction, it was at 80%. Now I think it's down to like 60%. So it's dropping because the global South is basically not using dollars for a lot of their cross-border transactions. So
Right.
it's dying, and so everybody's kind of in denial that it's dying. The budget deficit's a problem. So I think Trump and the Fed and the US Treasury are juggling these big problems, and Wall Street's been ignoring it for 2 years, saying debt doesn't matter. We've been in this MMT mindset for 2 years. And I'm of the opinion that we're not getting a soft landing. We're gonna get a recession, and Trump is not going to be able to prevent it. That's where I'm at. And I just don't know when it's going to start, 3, 6, 9 months. But the one thing that we do know, and I'll end it here, is the Wall Street, the money that's in equity in Wall Street right now, 40% is foreign money. And the US, all the New York City is the financial hub of the world, and all this foreign money is flooded in there. And once they start losing money, so we're at 6,000, once you're down 5%, you're like, oh, I'm going to hold, right? But once you're down 10%, which is 5,400, that's when you start jumping off the boat. And that foreign money starts flowing out of Wall Street. I think there's a lot of tension and fear of, because again, we're living on faith. We're living on faith right now that debt doesn't matter. But when it starts to matter, this thing could crumble in a hurry.
Okay. Thanks for the analysis. Let's jump into gold and silver really briefly just today, because we spend so much time every month going into a deeper dive. Let's talk just briefly about where gold is, where silver is. Let's start with gold. Why don't you kick it off?
Yeah, so I think gold is stuck in a range, say 2,600 to 2,800, and I don't see it getting out of that range until the stock market breaks up. That's where I'm at. I just think gold and silver are stuck in this range. A lot of people say that silver is just get. I see a lot of bullishness on Twitter. It's like silver's going to just rip here. It's going to take off. And I'm like, no, I don't see that. I don't see it taking off. I see it stuck in its range too, which is about $30 to say 34. It's stuck in its range as well. But they're both very volatile right now. We're seeing, $50 daily moves in gold, and we're seeing $1 moves in silver on a daily basis. We're seeing a lot of volatility. And I think the reason why is it's different for both gold and silver. I think silver's having huge volatility because it's just so darn cheap. So, and gold's having a lot of volatility. That one's a little bit more difficult to understand. I think it has to do with Asian buying. So the Asians, China will come in and push the thing up, and then the West will push it back down. It's like a fight between the East and the West for gold. But both of these metals are, in my opinion, are trapped until this market, it melts up, and then gold and silver go with it, or melts down, gold goes down a little bit, but doesn't crash, and then off to the races here. But I think Bitcoin is really showing us that Bitcoin and gold, I think, are somewhat tied at the hip, if you will, because neither have counterparty risk. A lot of people say gold and Bitcoin have nothing in common. Well, one thing they definitely have in common is neither of them have counterparty risk. And that's a big deal. And I think that's one of the reasons why people like Bitcoin. Like you hold Bitcoin in a hardware wallet, it's yours. It's like holding a borrowed gold in your hand. It's the same thing. It's yours. No one can take it from you. That's a
I
big
understand
deal.
that.
Big deal.
I don't want to get too deep into Bitcoin, but I will say that, like, I think Bitcoin was around 71,000 around the time of the election. I mean, it hit right around 100, let's just say round number, right? But that's a huge move for any type of currency in such a short period of time. And so to me, while I agree that they have some properties they may share, I think Bitcoin is a bullish asset. It's clearly proven that now, just recently, right? Like, it's not a defensive asset as much as people think.
I think it's going to become a defensive asset.
It might become one, but I'm just saying over the last
Yeah.
30 days, like, it's
Oh
clearly
no.
shown this is a euphoric, like, let's gamble. It's like a casino type asset, right? It's not, it's
Yes.
real and it has merit, but it does not have, like, it has hot money in it. That's all I'm saying.
Yeah. Yeah. I don't think it will become a defensive asset until the stock market crashes, because a lot
Right.
of people think that Bitcoin and the Nasdaq are tied at the hip. And that's the only Bitcoin and liquidity, they go hand in hand. And so until the stock market goes down and then Bitcoin follows gold up, that's when people will
Mhm.
go, whoa, what the hell's going on there? That'll be
Right.
another. Bitcoin is always challenging people to rethink things. And
Yeah.
that's gonna be another one of those situations where people go, what the hell is Bitcoin doing here?
So let me comment on your um, a little bit on gold and silver, just like you did there. I think gold, uh, we've been saying 2,300 is definitely a floor for us, and maybe 23 to 2,400 if you're looking at a range. And I think that range is going to hold. We've been saying all of last year that 1,900 was holding, 1,900 was holding. This is really bullish. And now we're seeing that same type of action once we broke through that 20 to 2050 level, that this new kind of floor at 2,300 has been formed. And that's really bullish if you're buying gold or gold assets, in our opinion. Silver, we bought a little bit more here, just over $30 last week, because I think that 30 being held for this many days in a row is extremely bullish price action. Wouldn't you agree? I mean, I know you're probably not going to agree, but I'm just saying, like, the hold 30, which was resistance for 11 years, is showing you that we're not going back to 26, in my opinion.
Right. For me, it's gold is such a larger sector than silver. Silver is kind of tiny. I mean,
Yeah,
there's probably a billion ounces of silver out there for sale. In time, that's only $30 billion, which is like peanuts compared to
yeah,
the gold inventory. So you can't really compare them. There's such huge differences in the size of these things. So for me, it's all about gold, and then silver coming along for the ride. So gold has been so strong, and it has a lot of reasons for being strong. And the biggest one is the US debt. I think
yeah.
the biggest reason why gold is so high is the US debt. That is the reason why central banks are buying gold, because they're like, the US is starting to have a problem here. And
Mhm.
mainstream media isn't going to talk about it. Wall Street isn't going to talk about it. The only people who are going to talk about it is your, the Luke Gromans of the world, or some of these other guys that are out there doing these podcasts. But that's the reason why central banks are buying gold, not because of inflation. It is not because they're not buying gold like crazy because of inflation. They're buying gold because we're having this um, a lot of uncertainty in international economics, and so
Right.
gold, that's putting a floor underneath gold. You said you didn't think silver would get to 26. I don't think gold will get to 22. So we both kind of
Yeah.
have that kind of agreement that there's some really strong floors. So
Right.
you have to look at, if we have these floors in gold, and I don't know what the floor is, 22, 23, 24, maybe even 25. I wouldn't go above that. We don't know until the stock market actually crashes how low gold will go. My guess is around 2350, but I'm guessing because we just don't know how these things all play out. But if that's the case, the higher level that gold, the higher floor level for gold will set the floor level for silver. Now, you said
Hmm.
you think 26 would get it. I think a 25 handle or a 26 handle is that's about as low as you can go. I do not expect to see
Okay.
I do not expect to see a 24 handle. And 27 holds, it wouldn't surprise me. If $2,500 gold holds, it wouldn't surprise me. But the key here, I think, is the bond market, the central banks buying gold. I think that trend is up. I don't think that trend's going away. I think the US economy is in big trouble because I don't think that Trump can fix that debt problem, because the problem is the way that you fix it, the way that you fix the debt problem is you have to cut spending. And if you cut spending, you create a recession because it's
Right.
70% consumer spending. So they can't cut. So it's a catch-22. And to fix the problem, you create a problem.
Yeah. And I think we've taken that so far now. It gets exponentially higher every single month that we continue to live this lie as a U.S. economy, participant, right? Like you're putting all this money on credit. If you look at auto loans, we've talked about this before, near all-time high defaults. If you look at credit card debt, near all-time highs. Like this is what's happening to the U.S. consumer. This isn't farce. This is truth, and it is affecting people on a day-to-day basis or a week-to-week basis, right? Like this, the anxiety of having all this debt accrued at a certain percentage rate that, yes, you've gotten a little bit of a relief in the recent cuts in September, but not that much. I mean, if you're accumulating debt, I just think there's still a lot of entitled people in our society, right? And they keep spending money. They're not pulling in their belt as much as they need to, and they're going to get walloped. It's just going to be a bad year, I think, for 2025, because if you're right about the economy, let's say it does go down 10% from rough number 6,000 S&P to 5,400, people are going to feel that in their 401ks because they have so much money in the S&P in their 401k. I would argue. I see a lot of clients. I look at a lot, like they're 65 plus people that have 30 to 50% of the S&P, and their entire net worth is in one ETF like SPY. It's really scary. And they should be thinking more about diversification, not necessarily like the bonds because the bond market's at risk, but more into gold and silver and some tangible things, right? And they have done that in real estate, but I would argue that real estate is going to be dependent upon how the S&P does too, because the stock market and real estate are intertwined. If you don't believe me, look at 2008 and 2009, right? When one fell, the other fell, and you're going to have that same dynamic, I think, in certain markets in 2025 and 2026, potentially, because I'm seeing it already in the West where we lived on. Don't you? I mean, like prices have peaked here in the West. People are renting for less. They're buying homes for less. Like the peak, the top is in Western U.S. real estate.
Yeah, I would agree with that. I agree with everything you said. The one thing that's pretty obvious to me is the economy is slowing. That's another thing that Wall Street's in denial about, is that it's not as if we've had the soft landing and now we're growing again. We're not. It's getting worse. And so that's Trump's going to try to kind of to reverse that and basically get housing growing again.
Sure.
Get the autos growing again. But they're both right now stagnant. Consumer spending, it's
stagnant. However, they grow so much if people do the homework, right? Like it's like the meteoric rise, especially in something like real estate, has something like it's never been seen in our lifetime, right? There's never been this kind of a rally, never. And I'm sure that we may see another one down the road, but real estate is extremely cyclical, and we have reached the peak, and it doesn't feel like it yet because we keep getting fed BS numbers from the U.S. government about housing starts. Look at housing starts. How well new home sales. Oh my gosh, things are just going through the roof. I mean, if you're building a project right now, imagine how many more months you have to get to completion, right? And then what does that look like when you launch your project, right? That's what people are missing, is that's what happened in 08, 09. People went over their skis, did so many projects, flip this, flip that, and then the music stopped and there was nowhere to sit.
right.
And that's going to happen again, but to a much bigger magnitude this time because the economy is just so much better off since 2008 and 9.
One thing I would say is that housing is really just one piece of the puzzle. It's like
Mhm.
there are so many sectors that are being impacted by this, by the economy. It's restaurants, retail, autos, everything is kind of getting squeezed here. And the biggest one of all is the consumer, because the consumer is basically broke. They can't afford their bills, except for the top 25%. Top 25%, they don't care. Inflation doesn't really hit them because they have so much
Right.
savings. They're
Right.
fine. They spend whatever they want to spend. It's the bottom 75% that are totally, hurting. And
Yeah.
that's might be the biggest problem with the economy right now, because there's none of this, excess funds to kind of stimulate the economy and get it going again. And I don't think Trump can really cut taxes that much. They're already fairly low. I don't know what Trump's going to do around taxes to stimulate, and he can't do it until October, and then it doesn't even go into effect until the next year, 26, our taxes.
Right.
So it's for him. It's not going to be easy for Trump to kind of fix the economy. The economy, as we've been saying, is broken. It's
Yes.
really a Potemkin economy in many respects. GDP. The only reason why GDP is positive is because we have a $2 trillion deficit. If we had a $500 million deficit, wouldn't have any growth. Somewhere around there, but you add $1 billion, a trillion, I mean, excuse me, to GDP. Um, it's we're we're basically printing GDP right now, printing growth through debt, which is dangerous.
Right. Well, let's pivot away from macro now and get into some equity ideas. Just, at year end here, we all know that November to December, or call it the end of December, really, Christmas for some, is sort of marks that tax loss selling period of time where things get sold, and this perfectly aligned with the November 5th election. As far as the names that I track, you started to see a lot of selling right after the election, and it hasn't really abated too much. I'm going to kick it off, Don, if you don't mind, with just a couple of gold ideas that I saw here recently that I think people can take a look at and do a little more homework on. Next Gold is one that you and I both like. NXGCF is the ticker. It's trading at 51 cents right now. But and I haven't checked the news as of today, but I know from the dates in my memory, they had that transaction with Signal Gold, which probably closed Friday. If not, it closed this week. And that would give them then 6 million ounces in the major categories of gold. But also, when you look at one of their other smaller projects, it gets them closer to 7 million ounces when I did the work on the weekend, um, which is unbelievable because if you look at the value of the shares right now, it's trading like nothing happened. Like it's unbelievable. If you look back on a 3 month or a 6 month chart, it really has been treading water. But positively, I think, the bottom got put in around 45 cents US if you look at a chart. Now we're trading about 51. So the volume's been picking up, which is a good sign. And I think the bottom is in. So we are, shareholders of that in full disclosure. Another one that I did some homework on this weekend too is Cartier Resources, which is ECRFF. Cartier's got 2.45 million ounces of gold, but they've been putting out consistent news over the last couple of months, um, talking about their resource in Canada. And what intrigues me about the stock is not only that the outstanding shares is misleading, it looks quite large, but when you do the homework, Agnico owned a large percentage, O3 Mining owned a large percentage, and the CEO and a lot of the board members and insiders own about 8 to 10% of the company conservatively. So when you add all of that up, it's well over 35%, which is one of the things that Don and I look for in terms of ownership, because we don't want to take under on an asset like that. So I think you check a lot of boxes with that resource. But the interesting thing to me is that Cartier is really, really near. They have a good relationship with Agnico, obviously, But now with the O3 transaction, those shares could go to Agnico, I think. I mean, if you look at the math, that could be up to 28% ownership on Agnico, if I'm correct, from under a 19.9. So they'd have a control type position. And Agnico has been making some very smart moves. In fact, Agnico is the one that bought O3 Mining for about 206 million, I believe, just last week. So that was a nice premium too, 57% and a cash deal. So that's it on the gold side. One thing that I noticed today, Don, and I know you don't follow this too closely on the critical side, but we have a lot of money invested in critical minerals. We saw Fireweed Metals, FWEDF, get a $35 million grant, which was a combined grant from the US government and the Canadian government. That was a very large grant. And of course, for those that don't know too much about grants, grants are non-dilutive to us as shareholders, right? So there are different terms to grants, but check out Fireweed Metals website. You can learn a little bit more about the news today. We own a lot of things. We own some fireweed, but we own some other things that could really get impacted positively from this news. Guardian Metal, GMTLF in the States, GMET.L in London, does not have a Canadian ticker. That is trading at 36 cents US. I think they're in line for some money as well, just based on the fact that they're in a better jurisdiction than Canada, in my opinion, in Nevada. They also just put out news that they're acquiring a second Nevada property. So, when I see a company taking a large landmass like that, it's really, it's really bullish because there's no tungsten publicly traded companies. The ones that we track are Fireweed, Guardian, and Demesne, DEME in Canada. So, those are some names there that you might want to look at in tungsten. But also, there's a couple other companies I'll mention that have really put out news saying, hey, we're partnering with the US government here, or we've done every piece of due diligence to get in front of the DoD or DOE. Two of those names that just put out news like this are First Tellurium, FSTTF, FTEL in Canada, as well as Stillwater Critical, which is in Montana. And that one is PGEZF in the States and PGE in Canada. Both are trading under 10 cents. It's unbelievable because when you see a deal like Fireweed, a $35 million grant, I mean, it would be game changing for either of those kind of companies with very small market caps to even get $5 or $10 million from the government. And I'm telling you, like, these guys have been talking, and they say in their press releases, we've been talking to our constituents and doing the due diligence and doing all the things we need to do to advance the project in a non-dilutive way. So I think that trend is going to continue, Don, as we see China and the U.S. really square off next year. Reading a lot of news about how, it's been a tit for tat ever since November 5th with Trump getting in office and kind of going after China once again.
All right. So I would start off because we have an opportunity here. I don't know if now is the time to buy, or do you buy half now and you wait for the correction? But I do think that sometime in the next 3 to 9 months, I do think we're going to get lower lows than we're at today. But I'm going to mention a bunch of names. So like I said, I don't know if now is the right time. You can look at the prices or just put them on your buy list and wait until that correction comes. The first name I'm going to mention is Newmont, which is trading at $40. Now, this is for a conservative, like a lot of people are like conservative investors, but I think that Newmont's going north of 150. So paying $40 for it and getting a dividend, I don't think it's going to go below 35. So I like to buy to the bottom. So what you do, like you buy it at $40. If it goes to 38, you buy some more. It goes to 36, you buy more. That's how you buy to the bottom.
Can I interrupt you for one sec? Just for our listeners' benefit, I know you're saying 40 to 150 in the context of a much higher gold price, right?
Yeah, $4,000 gold, which
Okay.
I don't think $4,000 gold is really that far away. I think next year we're going to get to 32 to 3,400, 25, and then 26. I think we get to 4. So it's not that far away. 2 years. I think Newmont rips from 40 to 150. So
it's funny you mentioned that.
I just,
Because I actually put an email out this morning saying Newmont just dipped below 40, and it'll be interesting to see if it holds support here. But either way, it's probably going to hold 35.
yeah. So this is a decent entry. And like I said, you can buy to the bottom. But if you're a conservative, you want a 1, 2, 3 bagger. Newmont right now looks really juicy. The other thing about Newmont is they're cleaning up their balance sheet and their costs are going to come down. And they're basically selling high cost mines. On that, now we'll go up one level, and the next one is quality. So I don't know if you guys know my Mormon list, but they're the highest quality silver producers. So the Mormons are Aya, Aya Gold and Silver, Coeur, and Silvercrest because they're merging. Then Endeavor Silver, First Majestic, who's buying Gatos, Fresnillo, Hecla, Hochschild, and Pan American. So those 8 names, I think, are quality. You want to own a bunch of quality producers and then just ride those guys all the way to the top. Then I have for my gold, I have what I call the Aussie 8. These are 8 Aussie mid tiers that all have market caps above $1 billion, 1 billion to 2 billion. And
Okay.
it's Bellevue Gold, Capricorn Metals, Genesis Minerals, Ramelius Resources, Regis Resources, and Vault Minerals. So there you have basically 16 quality producers. And then I would add Dundee and Orla to that group of basically quality mid tiers. So you basically go to like 18 there. Um, Now, I really like Next Gold a lot. The Signal deal did close. Um, they stole Signal. I mean, Signal was trading at like $20 million. It was like just for a really strong Goldboro project. I mean, 100,000 ounces for 15 years. I mean, and it was printed valued at 20 million. It was just ridiculous. And they basically stole that project. And the reason why is because the Signal board recognized that Next Gold was cheap. So like, hey, we're both cheap. We're not gonna hurt our shareholders. Giving the project to you guys, they're still gonna get this huge upside. So it was a really smart merger. I'm a big fan of Next Gold. The other thing that's awesome about Next Gold is both of their projects, both of them are going to get permitted next year. And then
Mhm.
they're not sure which one they're going to build first. It's probably whichever one gets permitted first. But if they get permitted
Right.
like 2 months apart, they might decide, but they haven't even decided which one they're going to build yet. That's how advanced they both are. So, I'm that it used to be Treasury Metals. I've been following it for 10 years, and they're basically now ready to rock and roll. So I'm a big fan of that. The other two, one's a development. The other one I really like is West Red Lake Gold. And nobody wants to touch it because they Pure Gold, the mine that they bought, went bankrupt because when they ramped up production, the grade was only 2.5 grams and it wasn't, and gold prices were not high enough. And so they went bankrupt. They weren't generating enough free cash flow, and they had a really ugly loan. And a lot of these loans are really ugly when you do development. What I mean by ugly is you have to pay them off like in the first 2 to 3 years. They don't give you, you know, that first year when you're in production. If you're not generating money, you're in trouble. They want their payments basically. They don't,
Right.
and they're usually pretty ugly loans. You either hit your numbers or else kind of thing. And so Pure Gold went under, but now West Red Lake, and they just did a financing. People got angry. They're like, why do they need 60 million bucks? I thought it was a low capex to restart it, but they needed that money because they decided that the ramp that Pure Gold was using was not optimal. And so they said, we're going to build a new ramp 1 kilometer underground, and it's going to be more optimal. It's going to reduce our risk. And I thought it was a smart move. And they also added a crusher. I don't know how much they paid for that, but they're like, well, let's add an additional crusher. And so I think West Red Lake is ready to rock and roll. So I like that one as much as Next Gold. Really, I think they're both very strong development plays. Another one I like a lot is Heliostar. Heliostar is they went from exploration play to now they're a 40,000 ounce producer, and they're gonna add production at La Colorada in January. And I think they have a very strong path to being a 200,000 ounce producer. So I think Heliostar, those three look great.
Okay.
And if you find to finish up, we're a little over our time here. Finish up. I have three optionality plays. If
Sure.
you are a big fan that gold's going to 4,000, then these three plays, you can just buy them and sit on them for that outcome. And the first one is Gold Ventures. Free Gold Ventures is probably my favorite optionality play because Eric Sprott owns 29% and another group, forget the name, what their name is, they own almost as much as Sprott, if not more. So they're both private shareholders. And they're basically, so the board can't do anything without making a phone call to these two people and basically saying, will you vote yes? And my
Yeah.
understanding is both of these guys are saying we're not selling below $100 an ounce, and it's currently trading like 10. And so the private shareholders have the board, they basically control it, that control this thing. So the only thing Free Gold Ventures can basically do is drill and wait for somebody to pay $100 an ounce. And that's what they've been doing.
Okay.
So I just love Free Gold Ventures. And the other two that have huge resources that are super cheap is Tudor Gold. The Tudor, they own 20% of 34 million. So they own about 20 million ounces of that project, which is growing. And then didn't like Tudor because it had refractory ore, but it turns out that I forget, you might want to double check on this one, but I think about 30 or 40% is not refractory. So they can start there. It's such a huge mine. So they don't have to start on the refractory ore, and then they can add that later, which will
Okay.
lower the capex when they start. And the final optionality play is Banyan Gold. They have 7 million ounces at 0.6 grams, but at $4,000 gold, it sure works. And their market cap is $46 million. So that's $7 an ounce. So those are my three optionality plays. So we gave you
Okay.
guys a bunch of names today.
We did. We did. Let me wrap it up with just a comment on two comments on what you just said, and then I want to wrap it up with some conservative ideas too, because some of these carry more risk as exploration or development plays. Next gold, NXGCF. Yes, both projects are going to get permitted most likely next year. We had Kevin Bullock and Oren Burnowski, who are the new CEO and CFO of the combined entity, at our Florida conference. They met with a lot of our clients down there, and I think that's going to be an excellent combination, as you pointed out. That is something that's super cheap right now. Again, like I think I have to double check this, but the O3 news that happened in Canada last week that I referenced, the buyout, that isn't that far from one of their two projects at all. And so like people are missing this. If Agnico is going to take out an O3, who really we owned a little bit of, but it wasn't something we had a big position in. I mean, I think some of their assets at Next Gold could get built by Next Gold. That's what I think the market is missing, is that Jeremy Wyeth and his team are pretty darn deep, and they could build one or two of those two assets. And that way they're going to hold these assets until we get higher prices. And then if they felt like moving on, then they would. But that's something that I know you look for, Don, is don't sell too early, right? And I don't think that they're going to sell too early. The other thing I would comment on is West Red Lake. I don't follow that company too closely, but there are some proximity plays that you and I have talked about in the past. I just started to look at Renegade Gold because I was sort of looking around the area to see what else was, available. And I don't own a huge position in that, but it's something that we're tracking. The other one is 1911 Gold, which just completed a financing or is in the process of a financing. I don't know. They publicly announced it like I think Thursday or Friday. But I think Sean's team there is positioned to do some, interesting things over the next couple of years. I know it's one of your favorite, gold plays that's flying under the radar. Lastly, I'll wrap it up by just a couple of conservative ideas I see out there because I do like the royalty model, and there's a couple that to me have really come down in price. Vox Royalty was trading almost at $3, Dom, when you and I hung out in Florida just less than 2 months ago, and today it's trading at 247. at 247, it's getting close to that buy zone for us of $2 to 210. And if it dips into that range, even 220, I think we would pay that easily for a company like that that has a yield. I think it's the highest yield in the royalty sector now, and it's got a very tight share structure, a lot of insider ownership. They have a good year planned next year. This year was one that they've communicated properly with the market to say, hey, we're not going to be having a barn bust, a barn burning kind of 2024. But look at our pipeline for 25 and 26, and that's what we're excited about. The other one is Ecora Resources, ECRAF. When I look at cheap royalty companies, this is one of the cheapest one that I can find out there. They're London based, so I don't think they get the same play in the U.S. But again, they have a pipeline that's very copper heavy for 25 and 26, and I like that. So a lot of their new stuff is going to be in the copper space, and I think that's going to align with a rise in copper price. I could be wrong, but Morgan Stanley, Goldman Sachs, big entities agree with me that copper is moving higher over the next 24 months. So we'll see.
I wanted to mention you got to mention some additional, so I want to mention a few additional.
You already mentioned 100.
Okay, so wait until Mexico approves an open pit. Once we haven't seen it, but when they give out an open pit permit, the first one that gets one, at that point, you want to look at these four names because they're all going to basically start ripping. The first one is Go Gold, and they want an underground pit. But once permits go, Mexico's going to improve. So Go Gold, then Silver Tiger, Discovery Silver, and Sonora Gold. Those four names, once Mexico approves a permit, those four names are just all going to rip.
So we interviewed the Sonoro team last month, you and I. That's SMOFF in the States, SGO in Canada. What's interesting about that? They did a raise after our interview, but the stock barely has moved. I mean, that's really rare. It's a small raise in fairness. It's 500-600K, but they're not going out there and raising $3 million right now because they're not drilling. Why would you need to raise all this money at cheap prices, right? They've done a really good job of managing the share structure there. It looks a lot bigger than it is, but when you actually call John, the chairman, or Ken, the CEO, and say how much of this is owned by insiders, it's a ton. A ton of the float is owned by the two of them, along with some board members and some insiders. And so, I think that one, like you said, could really do well when Scheinbaum comes around. And we should know a little bit more, Don. I think this week, I could be wrong, but I saw an article around December 11th that said she's going to be speaking on open pit mining before the end of this year.
Yeah, I expect a permit in Q2. I expect them to give someone a permit in Q2. That's my expectation.
Okay. So not a long wait. And yeah, all four of those projects are under pressure because of the Mexican overhang, if you will, that's existed now for months because of AMLO. So I think it's important to note that there is a new president there, and that she may have a better path for some of these mining companies, because they really do contribute a lot to their GDP in Mexico if they were to come online.
We should have charged for this podcast. We gave away too much.
We did give a lot away. Merry Christmas, everyone, and Happy Hanukkah, and Happy Kwanzaa, happy whatever you celebrate. We're going to wrap it up here. We had a great year talking with all of you, and I think it's going to be a tremendous 2025, even though it may not feel like it right now. So, Don, it's been a pleasure working with you this year, and we look forward to a great year together next year. And if you guys have any questions for us, my contact information will be following this. Happy to help if we can. And thanks a lot for joining us. Take care.